What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, guys, first day of the month, a little bit choppy. However, yesterday, something very interesting happened. I want to share it with you, especially because I am seeing such a consistent pattern on the internet from the news media, okay, from reporters, as well as everybody on Twitter. So I'm going to break everything down for you and give you an A to Z perspective. So let's get right into it. First off, as you can see, S&P and NASDAQ down just under 1%, a little bit red for the day. But I want you to focus right here on this headline. Stock slide to start June. Jamie Dimon, he's the CEO of JP Morgan, warns hurricane headed for economy. Over the past few months, we've seen the same narrative. We're in trouble. We're headed for a recession. Stock market's going to crash. However, it really wasn't until the past few, I would say 4 to 6 weeks, all right, and the trend has only gotten, picked up on even more, that every single person is bearish, okay? And if you've watched my videos before, you know that I've stated numerous times when one side becomes crowded, all right, because everything can get tracked, especially from retail. And if everybody's watching this channel knows that the market is completely unfair to the retail side. And when the market makers know exactly what retail is doing, that's when they switch things the other way. All right. We've talked about that numerous times. You could take a look at the put to call ratio, and puts have been heavily loaded. They were insane amount of put to calls, especially when the S&P got down to that 380, 385 level, to just completely rip you apart and bounce all the way back up on low volume to 420, okay, or about 417 to where we, sat as of this morning. My point behind this is, in times of uncertainty, okay, and in my experience, when things have happened, one, it's never smooth, and two, it's always from uncertain. If the world is prepared for one thing to happen, a lot of times that doesn't happen. Doesn't mean it can't happen. It's just a lot of times it doesn't happen. And if it does happen, it certainly does not play out the way you want it to, okay? So let's talk a little bit further about it. Today, quantitative tightening supposedly begins. And the reason why I say supposedly is because that is the Federal Reserve's plan. However, if things become a little bit too shaky, they might have to back off from their plan, even though they have stated, just like they did in 2018, that they have this plan and they're going to stick to it. Okay. So here's a couple of things that are going to happen. One, you have the biggest buyer in the Treasury market who has now become a seller. However, the buying had stopped in March, and the selling has been known for quite some time. We've talked about this numerous times, saying that the market is always forward thinking, meaning investors are prepared, and this is completely priced into the market. So keep that in mind going forward. But even more important, because everybody's eyes was on this June 1st, saying the quantitative tightening is starting. You take a look at the SPY on the 5-day chart. You had this nice steady upwards rise about to that 420 area. We couldn't break below that. We are still channeling. I will show you guys the QQQ, which is playing a little bit tighter of a channel. This one we played absolutely beautifully today. We talk about the reversals. If you're unfamiliar with supply and demand, go check it out all over YouTube. There are tons of videos talking about this. I went over this over my pre-market plan. QQQ looking to get this if it breaks above that support. However, I'll be eyeing puts at the rejection of 313. Same thing with SPY at 416 to 418. I wasn't able to get onto SPY that quick. I really thought it was just going to push a little bit more. It did break up into that supply zone. All right. However, I wanted to wait a little bit longer, and I didn't quite get it. However, QQQ played out absolutely perfectly, gave us a beautiful move all the way to the downside, okay? But it is still channeling. The indices are still channeling. We haven't really broken, that heavy level of support to bring us back down, okay, to those levels. But more importantly, and we talk about this from a larger time frame, and sometimes, especially when I was new to this, I would focus on smaller time frames. Look at just these 5-day charts, look at the 10-day charts, 30-minute charts, and sometimes I wouldn't go as far out as the weekly charts, okay? And taking a look at what's happening, what's the pattern forming on the weekly, all right? If I can get longer dated contracts, okay? Or if I'm looking to add my commons positions, right? Just normal swing trading, right? Or adding to my long positions, let me see what the market looks like, okay? Over a longer time frame. That way I don't get shaken out. When we look at the weekly time frame, we saw these 7 red weeks in a row. We knew we were oversold. We got this massive green candle, which is a bullish sign, even though we are only 2 days into the week. But let's go one step further, the monthly time frame, okay? And this one's really important because it was only just a few days that this was a massively, red candle to really bring it up to what's called a doji candle. Now, if you're unfamiliar what a doji is, there are a couple different ones. There are a gravestone doji and a dragonfly doji, but a doji candle means basically there's a lot of indecision. The amount of buyers and sellers is almost neutral at this price point. As you can see from these examples here, you can go and Google it and look it up for yourself as well. But you can tell it's almost like there's an even amount of buyers and sellers. Now, seeing this on a longer time frame, all right, it's the candle power of a longer time frame is a little bit stronger than it would be, let's say, a 1 minute, 5 minute, or 15-minute chart. However, it is known for a reversal. Okay, it is a sign for a reversal. It is a reversal candle. All right, now seeing this on a monthly time frame when the world, okay, is bearish, when every retail is bearish, they're selling every single pop. That's been the narrative. All right, let it ride up on low volume. We've talked about it on this channel numerous times. Let the low volume rise up, get to a little bit of point of a resistance, and literally just take it back down. It was clockwork, okay? However, eventually that is going to run out. You're going to get burned by it. Now, I do expect a little bit of consolidation to happen. Because it is a larger time frame, you're not going to look at this to see, over the next, month or two, a rapid rise back up to 480. Although it is possible over, a larger time frame like the monthly, it would be nice to see a little bit of consolidation before a push to the upside. But the point behind this entire video is two things. One, we are starting to see a little bit more consistency in the market. That insane volatility of every single day in the indices isn't really occurring. We're not getting, those 3-4% swings like we were back in March of April. So it is a little more comfortable to be able to look at a longer time frame and take a 2 or 3 day position, as long as your contract expirations are just a little bit further out, and the theta, which is a time decay, isn't really hurting you too badly. Okay, I've stated numerous times, thinking once we got down to that 385 level that I talked about all the way back in February, that buying pressure, I didn't feel really strong to me. So I do feel like a retest could potentially happen of that. However, keep an eye on this longer time frame going forward. Everybody is completely one-sided. All right, you do have, Europe, which had reported higher than expected inflation. Our numbers are going to be coming out in just over a week from right now, ahead of the June FOMC, which they've completely priced in another 50 basis point hike to happen. Last inflation numbers, they were down just a little bit. They did miss expectations. Look to see exactly what's consistent with June going forward. However, over the next month or two, if you get to see that consolidation like we've seen, getting back up to the upside, at least to be able to retest it, is not out of the question. Now, it does not mean that I don't feel like, we're going to see lower lows, okay? Or we're going to be able to test back down to that 380 level, or it just means the market's going to keep ripping. This was a massive move ever since 2020, some consolidation and so forth. However, in order for the market to confirm this downtrend even further, just know that retests are necessary. I talked about it a few months ago, saying that 458 to 460 level, the market needs to reject what was a previous support to confirm the trend is still intact. And in order for the market to reject that support, especially getting up to that 430 level, it has to get up there to actually reject it. All right. So when you see these getting down, 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 just be very cautious of it. And especially when you see a lot of the flow going one way, you're looking on Twitter, you're seeing everybody talking about, I'm just going to load puts. Just play the chart.